Canadians, you can leave your tax system. Unlike Americans, you can leave, but you have to do it the right way. In this video, how does the CRA know you've actually left Canada? Let's dive right in. Hello, my name is Javier Correa. I'm the tax director here at the Rothbard Group, licensed tax professional. Canadian citizens, unlike Americans, you guys can actually leave the Canadian tax system and keep your passports. This is a major advantage compared to your neighbors to the south. Think about it. American citizens are subject to the U.S. tax system and are in the U.S. tax net regardless of where they live. You can have an American citizen who was even born abroad, who has never set foot in the United States of America, and yet they will be tax residents of the U.S. Canadians, you have this major advantage. You guys can keep your passport, move to the Republic of Panama, move to the Cayman Islands, move to Barbados, move to any tax-friendly or tax-neutral country you can think of, and still keep your passport and exit the Canadian tax system. That is a major advantage. However, this privilege, this objective you guys can achieve is not without complications. There are challenges that you have to overcome. And the main challenge is just because you can't leave, it doesn't mean the government is going to make it easy for you to leave. There are several roadblocks along the way that you have to be mindful of and that you have to navigate properly in order to exit the system in a correct manner. So let's take a look at how this happens. If you are a Canadian tax resident, the first thing you want to do is choose your departure date wisely. This is one of the first things that I tell any Canadian client. Like leaving on January 1st versus leaving on October 1st does make a difference. Why? Because when you leave, you have to file your final tax return on April 30th of the following year. And that final tax return is essentially a dual status tax return where you're indicating that you've been a resident of Canada for X amount of months. And then from one date onward, you are considering yourself an immigrant, a non-resident for tax purposes with regards to the Canadian tax system. You can give yourself more time to accumulate wealth offshore, tax-free, in order to actually accumulate the liquidity to pay for the departure tax, which is obviously one of the major hurdles that you have to go through in order to properly exit Canada. So number one would be obviously choosing your departure date wisely. Again, let's say, for example, you choose to leave somewhere around March of any given year. That means you have about a year and a month to prepare for your departure tax and for the filing of your final tax return. Let's say you leave on March 15th of any given year. That means that on April 30th of that year, you're filing the tax return for the previous year, and then you have the full year. So that in that same year, you have the months of April, May, June, July, etc., all the way down to December to accumulate wealth in order to file your final tax return on April 30th of the following year, which is the year in which you will have to essentially come up with the liquidity to pay your departure tax. So again, the timing of everything is absolutely important. Now, Canada is notoriously challenging when it comes to the ties-based system, because you have to understand, in Canada, it's not just a matter of how many days you're spending in the country or how many days you're spending outside the country. While that does contribute a fair amount, in Canada, they're really going to look at the ties, the specific ties you have to Canada. And in Canada, they've divided this, the CRA has divided this into major significant ties and into lesser secondary ties. So look at the major ties first. The number one element you're going to want to look out for is the preservation of a dwelling, of a permanent place of abode in Canadian territory. So that means owning a home that is permanently available to you, or having a long-term lease of a property that is also permanently available to you. That is going to be a major red flag if you are leaving Canada. So the existence of a home that you can call yours in Canada is going to be a major issue if you want to exit the country. So if you don't want to sell your property, you absolutely want to keep it. Ideally, you're going to have to lease it to somebody at fair market value, at arm's length, somebody who is not your family, so who is not part of your family. You're not subleasing it to a friend at a lower than market rate. You really have to make sure that this becomes a genuine investment property, and that can be really tricky because CRA really does look at that in the fine details of your case and in the full analysis. Then the other major ties are family dependents. So in Canada, in many cases, you can be deemed to remain a tax resident of Canada if your spouse, your partner, your girlfriend stays behind and there is a significant tie between you guys, right? You want to make sure that when you embark on this journey of potentially exiting Canada, your spouse, your common law partner is coming with you. That is going to be very, very important. Or if they can't come with you right away, it's important that they come and join you shortly thereafter. Now, when it comes to children, similar logic. If you have kids and they are staying behind in Canada, and I mean minors, so children that are obviously financially dependent on you, then that can also be a major trigger and a major connection that the CRA can use to basically determine that you are still a tax resident of Canada. Now, let's look at the secondary ties. In the case of the secondary ties, think of them kind of like a zombie horde. You know, I love zombie movies, zombie TV shows. Think of The Walking Dead, Land of the Dead, etc. One single zombie alone, you could probably take him on. However, a herd of zombies, all hungry, all together, coming at you at the same time, that can be a lot more challenging. That's the same thing that happens here with the secondary ties. One or two secondary ties on their own, that can be handled. But if you have a ton of secondary ties together, that can truly become an issue. So what are secondary ties? Credit cards in Canada, investments in Canada, bank accounts in Canada, businesses in Canada, any kind of overall financial connection, extended family in Canada. Obviously, you know, other kinds of personal property, like let's say a vehicle, for example, that stays behind in Canada. The aforementioned investment property, even if it's not your permanent primary residence, if it's still an investment property that is located there, you know, that still can be considered a secondary tie. So you want to be very strategic about what secondary ties you leave back home in Canada, which are absolutely crucial. Like, for example, having a Canadian passport, like having Canadian citizenship, that can be considered a secondary tie, but obviously you're not going to give up your passport, or the vast majority of you are not going to give up your Canadian passports, but we have to really pick and choose which secondary ties are absolutely necessary. That brings me to another element, which is ties to a new country. So Canada, unlike certain European nations, for example, doesn't necessarily require that you clearly establish tax residence and ties to another country. Canada cares more about the ties you have to Canada. And so essentially it is theoretically possible to exit Canada while not necessarily entering another country. However, here at the Rothbard Group, we often recommend to clients that they actually establish those ties to the new country. In our case, the vast majority of Canadians we work with are relocating to the Republic of Panama. And the reason why I say this is because the more ties you have to your new country of residence, the stronger your case is against CRA that you have actually left. So if you're ever audited, if they ever follow you, if they ever want to ask follow-up questions, if they ever want to look at your case more closely, more in detail, then essentially when you show that you have, let's say, permanent residence in the Republic of Panama, you have the red carpet visa, you have bank accounts in Panama, you have a business entity in Panama, or, you know, it could be Barbados, it could be Cayman Islands, you fill in the blank. As long as you show that you have business, family, and social ties to your new country, that can make a huge difference. In fact, social ties are often very much underestimated. Club memberships, gym memberships, religious affiliations, political party affiliations, driver's licenses, all of those things can be considered secondary ties to Canada if you keep them in Canada, and they are weakened as secondary ties to Canada if you establish these ties in your new country of residence, i.e., for example, the Republic of Panama. Now, let's assume that you've done all of this properly. Like you've worked with somebody like the Rothbard Group, you've gone through all of these details, primary connections, secondary connections, the ties, you've established residence in another country, you've done everything properly. Guess what? You still have to deal with the departure tax. So you file your final tax return, as we described earlier, you still have to deal with the departure tax. And so you need to take a look at your assets one by one and determine whether or not there is a deemed disposition that is triggered on those assets, and if there is any accrued gain that could lead to a capital gain tax on those assets, even if you haven't sold them. So in a nutshell, what are we looking at here? Real estate located in Canada, that is exempt from the departure tax. Retirement accounts, largely speaking, you have to take a look at them in more detail, but largely speaking, they can be exempt. Most other assets, I'm thinking real estate located outside of Canada. So that vacation home in Fort Lauderdale or Hawaii, that apartment you just bought in the Republic of Panama for your visa, any shares you may have in private companies, say you own your own business in Canada, so shares in a limited company, that counts for the departure tax. Your stock portfolio, let's say you own stocks they're traded on Wall Street, for example, that is included in the departure tax. Your crypto crypto is included in the departure tax. Precious metals, so for example, gold, etc. If owned as a standalone investment, not within a retirement wrapper, that is most likely going to be included in your departure tax as well. So you're going to want to make sure that you have a clean inventory before you make this move of all of your assets. You want to understand what the purchase price was, what the current market value is, because you are going to be deemed to have sold these assets at fair market value. So you want to make sure that you understand whether or not you've accumulated appreciation. You want to make sure that you use up any major Canadian tax advantages that have been built in to these assets while you're a resident of Canada. For example, in Canada, there are certain advantages for small businesses. You can have a capital dividend account within your private limited company, potentially. So you want to make sure that essentially you've used up all of these advantages before you become a Canadian tax non-resident, and maybe you won't be able to access those any longer. Now, let's say, again, you've done all of this properly and you say, well, Javier, I really don't want to get rid of these assets now. I don't have the liquidity to pay for the departure tax. Do I have any options? Well, there are a handful of them. You can decide, for example, to defer the departure tax. That is possible. You can get, for example, a letter of credit from a Canadian bank. You can provide some kind of security to CRA. You can use Canadian real estate to do that as well, for example. And theoretically, you can defer the tax. The mechanics can be a bit complicated. There's a cost to doing that as well. But know that it is a weapon that could potentially be in your arsenal. And the last element I would add for Canadians that are looking to exit and that are concerned about how CRA is really going to know, right? So you are filing your final tax return, you are presenting an inventory of your assets, you've obviously paid your departure tax if you have to pay any at all, you've severed your ties, which is also the major indicator to Canada that you've left and all of that. But there's one US style element that chases you for the first 5 years after you've left Canada, and most CPAs and most attorneys out there are not going to tell you about it. Here we talk about this with our clients on a daily basis, which is the potential deemed residence rules for Canadian trusts. Now, this can be quite complicated, but know that in Canada, when you have a trust, the Canadian tax system looks at the trustee. It looks at, obviously, the contributor, what in the US we would call the settlor, you guys in Canada call the contributor, and obviously the beneficiaries. Now, there is a rule wrapped around what they call, what the CRA calls a connected contributor. If you are a Canadian tax resident and you've left, and in the first 5 years you settle a trust, and remember, a Panama Private Interest Foundation can be treated as a trust and will most likely be treated as a trust for Canadian tax purposes. If there are certain conditions that apply, like having a resident beneficiary, for example, in this scenario, then you could unintentionally make your trust a Canadian tax resident, even if you've already left Canada. Imagine how crazy is that? You've left Canada, but yet you are considered a connected contributor if your beneficiary of your trust is back home in Canada, and you can essentially drag your trust back into the Canadian tax net, even if you've left. So, bottom line here, folks, the CRA has many tools to determine whether or not you are truly a tax non-resident of Canada, and you have to work with a professional to navigate this correctly. Canadians, again, you can leave. Take advantage of this. Americans cannot leave. Americans, in order to leave their tax system, they have to renounce their citizenship, which is a very difficult decision from a political, emotional, and financial perspective. You guys have that major advantage. You do not have to give up your passport. You can stay citizens of Canada and still relocate to tax-friendly or tax-neutral jurisdictions like the Republic of Panama, but it's not easy. There are many challenges in these perilous waters, and you have to have a captain at the helm that can steer the ship correctly. So we want to look at your primary ties, your secondary ties. We want to look at the deemed residence rules for trust. We want to look at your assets and inventory, appreciation. Everything I just mentioned has to be dealt with surgical precision, but it can be done. So if you're interested in learning more about the Canadian departure tax and you want it handled properly, rothbardgroup.com, we welcome the opportunity to work with you, and I'll see you in the next one.